Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading.
If I'm a portfolio manager, I have different risks in the option market that I'm always going to have to try to hedge. Delta, which would be some kind of direction risk that I need to hedge. Gamma would help me figure out how much I would have to hedge my directional risk due to changes in the dollar. If I was going to hedge Vega, I would be trying to hedge volatility. If I was going to hedge the other two here, Thea and Rio, then I'm talking about time decay and interest rate risk. But the interest rate risk is not so much of a concern right now. So it would, again, depend on the portfolio that you have, which one of these risks would be more important to hedge, okay? So if time decay is of concern, then the Thea neutral hedging strategy should be used. If a drop in the value of the underlying is of greatest concern, then delta neutral hedging would be good. But these are advanced strategies that you have many experts come on here and talk about all the time. And so I'm going to, I know Steve covered these strategies quite a few times, but we're going to come up here with our slides to actually see where we are in our trades, starting way back here with the dollar versus the Australian dollar. Now, we had a big stage 4 decline, and since this was one of the very new currencies that just came out on the ISE, it really doesn't have very much history, okay? So I would, again, use higher time frame charts from a few of the indexes that have traded, like the spot Forex markets, and I would just prepare to plan for trading my trades. We had a trading range at this point in time where we had a support down at around 104, and we had resistance at 107. And again, this was the beginning of July. So my plan was, as long as I was in this trading range, I would buy the calls at the bottom of the trading range, and I would buy the puts at the top of the trading range for a simple strategy. Okay, so my entry strategy was, as long as we traded in the 104, 107 range, I would just buy calls near the bottom of the range, buy puts near the top, and make a plan to enter a breakout to the upside, a stage 2 breakout, by buying 108 calls, which again, they broke out of that trading range back in August of 2008, and so my position was entered on the breakout of the range. Now, since it was inside of a trading range, I should point out that one of the ways that you could protect yourself in case there is a big move lower, with at that point in time there was very low volatility, would be to buy a married put. So at the same time that the 104 call option was purchased at the bottom of the range, a 104 put option to protect the position would provide protection against some kind of a collapse of the dollar. You got to understand something, guys. With the hedge funds that are collapsing all the time out there, with all the volatility that's going on out there, and at that point in time, really I hadn't been able to put two and two together what was going on. That would be a very logical way to protect yourself. Okay, and what did happen was there was a breakout of the bottom of that 104 range to the 52-week low of 101.50 right before the actual big rally that broke out of the top of the range. So in that case, your puts would have gained protection, or you would have offset any of the loss. You are using options, so you're defining your risk by the premium paid as long as you're buying calls and not selling or anything. So it would be a good strategy if and when we do have another trading range situation. Okay. Here's a chart now on 8/12 where we actually poked through here down to make the low. Again, that was the 101.50 low on the year. We came back inside the range the following week. And if you're using an option position, here's the good news. If you're using a leveraged Forex product where you're 100 to 1 leverage or 400 to 1 leverage or something like that, you could not possibly take that drawdown. So you would have had to exit your position. But since you've bought a call option, a 104 call option, for a while there, it's it could expire, but that's the most you could risk, and that's the most you could lose. So using options would be a fabulous way to enter these positions if you don't want to trade the actual spot. So after a period of time now, we've broken out of this range, and we've started to base at a higher range between about 114 and 117. So at this point in time now, I'm looking where I have a nice gain from either 108 calls on the breakout. If I still have 104 calls that are still, still have some time left in them, I have a very nice gain. Of course, what's working against you as an options trader always is time. So it's possible at that point in time, take a profit on your 104 calls if you're still holding them. If you did buy the 108 calls on the breakout of the trading range, then you can hold on to those calls, especially if you bought yourself a few more weeks or months of time. A general rule that I use is 45 days. I never like to go less than 45 days. Again, at that point on 9/1, I had a couple options to actually hedge this position. I could use what we call a hedge, a protective put below the bottom of the range. It's some kind of a static hedge to where a trade is established and held without the need to rebalance. So I could rebalance if I need to on a breakout to a higher range. But if I don't, I can just leave the spread at that point in time. Now, if I was expecting some kind of a moderate drop, I had the opportunity for a bear put spread. At that point in time, I could have also done some kind of a strategy where I sold higher calls. Okay, but usually after a big breakout like what had occurred from the lower level there, these currencies have a chance to move. They do trend a lot. So you have to make the decisions that are presented to you at the time that you're actually planning your trades. So these were some of the options I had on 9/1 to hedge my trade. Now, a few weeks later on 1 week later on 9/7, I broke out of the higher trading range, and now I'm trading in a range here from 118 closer to 123. Okay. So now I have a nice problem. I have if I did hedge, of course, I now have a higher range that I have to look at hedging. So instead of a static hedge, I would need something more along the lines of a dynamic hedge, which means, okay, I've got a problem here. I've got no protection really at this point, or I'm leaving too much money on the table. And so to try to protect that, I would have to rebalance due to a significant move, similar to the move that you saw on the prior chart. But again, I'm always worried after a big move like that I'm going to set myself up for some kind of a parabolic profit taking. Okay, so my existing position, either I have the September long calls from the 630 purchase, or I'm long the September 108 calls, or I might have actually used even a later strike if I wanted to. But at that point in time, I would use either a higher protective put based on the prior week's low, or I would whip out a Fibonacci price ladder for put placement protection. Okay, and again, if another higher range called, I could think about selling higher price calls again. So in this case, what I did was I pulled out a Fibonacci retracement tool. Okay, you're going to have a very good presentation coming up here in a few weeks on Fibonacci's, and in the meantime, what I would do is I would say that any kind of a strong move would never retrace usually more than either the 23 or the 38 Fibonacci. So I would place my put protection below those Fibonacci levels, and in this case you can see on that chart there I'm pretty close to 116 on the 38 Fibonacci. I always say, listen, if I'm going to retrace 50% of this move, I might as well close the trade. I'll have an opportunity for entries at different points. So this is just sort of a rule of thumb, and another way that you can figure out where to actually place your protective puts on this trade. This is the Australian dollar now on 9/7. Okay. Let's review where we are now on 11/13. When I did this presentation, I put the slides together. We have moved now from the 104, 107 range to a high of 165.69. So that was a spectacular move from the range that we originally traded from. Buying 108 calls on the breakout of the range would still be a position worth hedging. Several hedging strategies based on the current range between 142 and 165 are possible right now. And again, since I'm in this higher price trading range and it's as large as it is, I actually have the opportunity to trade that trading range using the option strategies that I used at the lower end of the trading range.
Thank you for listening to our podcast. Please visit www.ise.com/podcasts.